There has been a trend which has been playing out in the market where personal loans, of course, have been outstripping the growth in non-food credit. So if you look at the latest data from the Reserve Bank of India, this is the September year-on-year numbers. Non-food credit growth was at 6.1%, but personal loans grew at 16.8%. And the RBI classifies personal loans in the following categories. You will see those on your screen. So within that personal loan segment, consumer durable loans, which in the past used to be a big play, have actually not grown. They've degrown. Housing loans grew at about 7.6%, vehicle loans at about 9.2%. But the real big growth has been coming in credit card loans and other personal loans, which tend to be unsecured loans. Now, this is not just a September trend. This is a trend which is mapped out over at least the last 12 months or so, where some of these categories are growing faster than others. Joining us to talk and help us understand what's going on here is Shanti, Ekambaram, President of Consumer Banking at Kotak Mahindra Bank. Very good morning to you, ma'am. Lovely to have you here on BloombergQuint. Yeah, I first want to ask you whether the kind of growth that you've been seeing in some of these segments, in the credit card segments, in the other personal loan segment, this is all going by RBI data, is surprising or away from trend to you, or do you think this has been the way it's been moving for some time now?
I think if you look at the last 2 to 3 year data, Ira, you just talked about the 12-month data. The personal loan segment actually has grown in the range of between 16 to 20%. So India has been consuming, the urban and the consumer has been consuming, and they typically take these loans for their lifestyle needs, for travel, for holidays, for margins, for various things that may need. So you have been seeing the increase in trend of these loans over the last 2 to 3 years. So it is not just a 12-month phenomena, where you have seen, a lifestyle consumption goes up, and I think that is what mirrors the trend.
Okay, so ma'am, now let me start getting into some of the sub-segments. Now, there used to be a time where consumer durable loans were really big, but that segment actually has become de-emphasized, and even when you talk to people, they're not focused there so much anymore. Why is that, ma'am? I mean, is the demand or the interest from the lenders end shifting towards more unsecured loans? I mean, I know even consumer durables would have been unsecured, but things like car loans, which people used to prefer to give, are they de-emphasizing that and moving towards unsecured and other personal loan segments, as they're called?
No, actually, I'm surprised you say that, because if you saw October probably saw the highest ever consumer durable loan growth that you could have seen. Obviously, there was a October, because you saw the festive season and people typically go out and buy. If you look at the entire retail lending segment, Ira, you've seen car loans have grown, you've seen home loans growing, you see personal loans growing, you see credit cards going, and obviously consumer durables are going. So if you look at the underlying pattern of all this, basically consumption as a theme has continued to be stable and growing. What is happening, if you look at the overall space, is that corporate activity and investment activity has been low, while the consumption has been stable overall. Urban consumption has been stable and growing. Thanks to 2 years of favorable monsoon, rural also has become a little more stable. So you're seeing growth in retail consumption across the segments, and thus lending is mirroring across the segment. So it is not one at the cost of the other or one in lieu of the other. So you're seeing a broad consumption theme play out, and financing is just an enabler for the consumption theme that's playing out.
I get that, ma'am, but is unsecured as a part of that consumption credit going up again?
I think if you look at it overall as a segment, unsecured loans, I think about 2 years ago were about 5% of GDP. Today they are about 7% of GDP. India's GDP is also, reasonably growing and is expected to grow. So yes, unsecured loans have grown, but have they grown at the cost of the others? Probably not.
Have they grown in a slightly different manner than they did prior to the global financial crisis, which we, after which we know that we saw some jitters on the unsecured segment? A lot of people you talk to, particularly on the NBFC side, ma'am, say that now our ability to assess credit is strengthened. Do you see it that way?
So there's a difference between 2007-8 and now. One, Bureau data has made retail lending significantly more organized, because you have details and data about individuals lending, their CIBIL scores, and you know what exactly is happening in terms of their leverage and their borrowing. Second, credit appraisal method you talked about. Today you have other data, right? You have transactional data. Say, for example, as a bank, we sort of lend a very large to our existing customer base. So you have transactional data, you have social data, you have scorecards that have come. So I think the manner of lending has become more organized, and with bureau data, in terms of data availability for lending unsecured, it is very different from 2007 and 8. And third, like I said, post 2007 and 8, there was a lull in the consumption. The consumption has picked up in the last 2 to 3 years. It has continued to be stable and growing. So yes, because of the availability of organized data, because of the availability of other, what you call, transactional and other data, you are able to sort of put a scorecard and able to lend much more than perhaps in 2007 and 8.
Shanti, good morning. Niraj here, joining in the discussion as well. Do you guys have a model to predict, or past experiences which would probably enable you to figure if this lending cycle could well continue? Because as you said, one thing that we gather is that the nature of the Indian consumer is a lot different right now. More willingness to borrow and spend for today as opposed to saving for the long term. And two, the penetration levels would also be different, and the income levels of the tier 2, tier 3, tier 4 towns would also be much more different than what they were back in 2000, 2008.
So you're absolutely right. There are 2-3 things that drive it. 1, economic growth. B, jobs. 3, income streams. And 4, lifestyle aspiration. If you look at all 4 of them relative to 2007 and 8, they are significantly different. And each and every one of them contributes to what you call the consumption demand, and thus the demand for financing. So you certainly have seen that as economies grown, as long as jobs remain stable, people's earnings are going up, their aspirational value has gone up, and they will borrow. Even today, if you, for example, look at India versus the developed economies, roughly household debt to income is just at about 36-37%, while if you look at US, UK and Japan, they're all above 100%. I'm not saying we get there. Second, a large part of the Indian household borrowing is still for a home. Right, and I think Credit Suisse had put out a report recently which said that a large part of the borrowing is still for home. The lifestyle and the aspirational borrowing is still relatively a smaller portion. Yes, it is higher than what it was in 2007 and 8, but housing still forms the largest portion of the household debt, and household debt to income is perhaps at around 36-37% of the GDP. So if the economy continues to grow, if jobs continue to be stable and growing, which I expect in a growing economy, and income obviously goes up, consumption will go up, and so will the financing and the aspirational value. And you're talking about urban, you're talking about tier 4, 5, 2, 3, rural. You're seeing aspirational value go up across, and this is just reflected even in the whole e-commerce story. Sure. When you find that tier 2 and tier 3 towns are really sort of buying up a lot of the products.
Okay, so I had a follow-up question, but I think she's already answered my question. She believes it will continue.
Okay, ma'am, but okay, so coming back to the sort of question of the manner in which this lending is taking place. So, for instance, at your end, what is the lowest sort of CIBIL score above which you are lending, and is that markedly different for, say, the NBFCs? Because there is everybody in the market, in the retail credit market right now. There are NBFCs, there are banks, PSU banks. Everybody's playing in that market because, like you said, there is hardly any corporate credit demand. There seems to be too much competition.
I can talk about banks.
Okay.
Bank like us and most banks largely look at lending to their customers, both existing as well as new customers that they keep acquiring every month. Now, when you lend to your customers, you have transactional data, you have their account with them, you have a lot of data availability, you have CIBIL scores. Now, you can't say that, okay, I will lend 700 and above CIBIL score. It's easy to lend, right? But if you go below 700, you will have to support it with other transactional data. So it is not just about CIBIL score. Lending is about a whole host of other factors that you take into account: what the person's, where the person is, what are their jobs, what is their income, what is their debt, what is their capacity to pay, etc. So a large part of the banking sector lends into their customer base and their incremental customer base. Now, non-banks, I mean, like I said, I can't comment on the non-banks. Second, there are newer markets. Most people are operating just in the top, 10 cities. Then you go to the next 15 cities, to the next 20 cities, then you go to the next, 20 cities. So India is a very large place, and as you know, underbanked and underleveraged. So some of the others, particularly the NBFCs, are finding newer and newer markets to go to where banks have operated in certain markets. So I think it's a mix of all of this.
So you don't think there's a risk of, say, the NBFCs lending over and top, the same segment that banks were lending to? You go back to a microfinance kind of scenario where multiple lenders are lending to the same segment, and while at an economy level we may not be over leveraged, we certainly are not, but that consumer segment ends up getting over leveraged.
There certainly could possibly be at a risk. I don't think it is now, but you got to watch how it goes over the next 2 to 3 years. Anybody, having multiple lending, multiple borrowing and living beyond their means basically is at a very logical basis a problem. I don't think that the system is there yet, but if you go over the next 2 to 3 years, depending upon how people, and see, ultimately it is about philosophy of risk. Even in the wholesale corporate segment, there were many banks who did not get impacted by it, right? So just like that, as long as you have your risk philosophy, policies, diligence, and lending practices and underwriting practices, within a certain framework, I think you can continue to sort of grow the business.
Ma'am, one specific question on the credit card segment. Now, again, there we've seen outstandings, based on the RBI data, go up quite a bit. But the general understanding is that the rollovers have not really increased. And the other thing is that debit card usage is up very significantly as well. Can you tell me what you've seen at your end on credit card, whether rollovers are better than earlier, slightly, they're increasing, or they're more or less steady?
So there are two things you must know. What happened post demonetization is people in India started using their cards significantly. First was debit card, because credit card penetration is still relatively low, while everybody who has a savings account has a debit card. Debit card usage went up dramatically, while it came down a little bit post demon around maybe June, July, but even now as a percentage of usage significantly higher than what it was last year. Similarly, people who had credit cards started using credit card as a means for payment because it was very convenient. But a lot of people pay within that 30-35 days, while many of them roll over. So as far as rollover is concerned, I'd say there has been a marginal increase, but usage of credit cards certainly has gone up, both debit and credit cards. Different banks probably face different scenarios, but rollovers have gone up marginally, but an overall spending base has gone up significantly.
All right, ma'am. Interesting discussion there, what's happening on the consumer credit side. Appreciate you taking the time to speak with us there, Shanti Ekambaram.